Claire forgot to count the hours. James almost forgot to count the zeros. They both started with $60,000. They both committed to 20 years. And when the time is up, the one who forgot the smaller thing ends up with $128,000 more. This is the math almost nobody finishes in the real estate versus stocks debate. Everyone has an opinion on this debate. What almost nobody has done is count everything. Not rent minus mortgage, but every number, including the ones that don't show up in year 1 or year 5 or even year 10. So let's count everything. Same person, same money, same 20 years. One investment that feels like winning, one that feels like nothing, and an outcome that will change how you think about both. 2 investments, same person, same $60,000, same 20 years. The only rule is that we count everything, not just what looks good on a napkin. Claire and James are both 32 years old. Both earn $75,000 a year. Both have spent the last several years living below their means, skipping expensive holidays, driving the same car a few years too long, saying no to things most people their age said yes to without thinking twice. Both have managed to save exactly $60,000. That $60,000 represents years of real discipline. What they do with it next is going to define the following 2 decades of their financial life. Same starting point, same discipline, same $60,000. One variable. Claire uses her $60,000 as a 20% down payment on a $300,000 rental home in a solid neighborhood. She takes out a 30-year mortgage at 7.5%. Her monthly mortgage payment comes to $1,678. Within 3 weeks, she finds a tenant willing to pay $2,100 a month. After the mortgage payment, Claire keeps $422. She owns a $250,000 asset. The bank is carrying most of the weight, and she's pocketing extra money every month on top of it. Claire feels like she's already won. She drives past the property on Sunday mornings, and the feeling doesn't get old. She tells her sister about it at dinner, and her sister asks 3 follow-up questions she's never asked about anything financial in her life. Claire claims mortgage interest on her taxes and saves $2,000 on her tax bill. She builds equity with every mortgage payment. She watches comparable homes on the street list for more than she paid. Her tenant renews for another year without being asked. Every single piece of this investment feels concrete, tangible, and correct. At work, when the subject comes up, her coworkers lean in. They want to know the numbers. They want to know the neighborhood. 2 of them ask if she'd consider helping them find something similar. Claire is the person in the room who figured it out. That's what this feels like. That feeling is going to cost her. James takes his $60,000 and deposits it into a broad S&P 500 index fund. He sets up an automatic contribution of $300 a month, exactly what Claire will be putting into the property each month beyond what her rent covers. He gets a confirmation email. He goes back to his life, no property to drive past, no tenant to call, no story to tell. At the barbecue that summer, someone asks what he's investing in. Index funds, he says. There's a brief pause. Someone changes the subject. James's investment doesn't feel like anything. It's a number in an app that goes up most months, down occasionally, and asks nothing from him in between. While Claire is building something she can point to from a car window, James is building something that barely feels real. But feelings and math are 2 very different things. 3 years pass. Claire has collected approximately $75,000 in rent. Her mortgage payments have totaled $60,000. On paper, that's $15,000 in cash flow. Her property has also appreciated. At 4% annually, it's now worth around $337,000, and her equity has climbed to approximately $105,000. She tells her sister she's up over $100,000. Her sister tells 2 friends. James's portfolio sits at around $92,000 after 3 years of contributions and market growth. He hasn't mentioned it to anyone. There's nothing to mention. It's a number in an app. On every visible measure, Claire is winning, and visible winning is exactly what makes people think they've already figured out the answer. Claire thinks she's figured it out. She hasn't counted everything yet. The rent check is the number everyone talks about. It's on the thumbnail of every real estate YouTube video. It's the figure at the real estate meetup, the story your landlord friend mentions at every barbecue for the last 3 years running. It's the number in the Reddit thread, the podcast, the seminar about passive income. What nobody finishes telling you is everything that comes out of that rent check before it reaches your pocket. Property taxes on Claire's home run $2,800 a year. Insurance adds $1,400. Routine maintenance, the things that wear out because a house is being lived in, averages $3,000 a year in a good year. 1 month per year, the property sits empty between tenants, which means $2,100 gone before a new lease is signed. Every turnover costs $1,200 to clean and relist. Then, there are the ones nobody includes in the original spreadsheet. Year 9, the roof. $9,200. One invoice, completely unavoidable, arrived exactly when Claire was planning a holiday she had to cancel. Year 14, the HVAC system. $6,800. Also unavoidable. Also not in anyone's original cash flow calculation. Add all of it together and Claire's hidden cost stack over 20 years runs somewhere between $100,000 and $120,000 on top of every mortgage payment she ever made. The rent check was never the number that mattered. It was always just the number that felt good to say out loud. Claire didn't buy an investment. She bought a business, and nobody sent her the job description. The 11 p.m. call about the boiler. The Saturday morning the ceiling was leaking. The 6 weeks she spent going through the eviction process with a non-paying tenant, a lawyer, a hearing, and 4 months of lost rent before the keys came back. None of that appears anywhere in the original math. You don't own the property owns you, and time is the one thing compound interest cannot give back. Year 5. Claire's property has appreciated to around $365,000. She owes approximately $226,000. Her equity sits at $139,000. James's portfolio, $60,000 initial, $300 a month for 5 years at 10%, has grown to approximately $120,000. Claire is still ahead. Leverage is doing exactly what it was supposed to. But James hasn't made a single phone call. He hasn't met a single tenant. He hasn't paid a single repair bill. He's behind on paper and ahead on every other measure that a spreadsheet doesn't capture. Year 10. Claire's property is now worth approximately $444,000. After a decade of mortgage payments, she owes around $202,000. Her equity, $242,000. James's portfolio at the same moment, approximately $218,000. They're remarkably close. Claire is slightly ahead, depending on exactly how the local market moved. But underneath that comparison is a fact the equity figure doesn't capture. Claire reached $242,000 while managing a property for 10 years. James reached $218,000 while essentially doing nothing. The quiet crossover is already happening beneath the surface. Real estate has one genuine superpower that no index fund can replicate. And if I skipped it, I'd be doing exactly what the stock market influencers do, telling half the story. Leverage. James used $60,000 to control $60,000 in assets. Claire used $60,000 to control a $300,000 property. When that property appreciated, she earned returns on the full $300,000, not just her $60,000 down payment. No index fund replicates that structure. Real estate investors also get to deduct the theoretical depreciation of their building from taxable income, even when the property is actually appreciating in value. That's a legal tax shelter that stock investors simply don't have access to. And when the stock market fell 37% in 2008, Claire's equivalent property held most of its value, kept its tenant, and kept generating income. James's equivalent portfolio lost a third of its value in months. That psychological reality is real, and dismissing it because of a spreadsheet would be dishonest. The case for real estate is legitimate. The case for real estate as a passive investment is not. 20 years later, at 4% annual appreciation across 2 decades, Claire's $300,000 home is now worth approximately $657,000. After 20 years of payments, she owes around $151,000. Her equity, $506,000. Genuine, significant, real wealth. Leverage did exactly what it promised. James's portfolio, $60,000 at 10% annually for 20 years, plus $300 a month in automatic contributions he never thought about. His portfolio has grown to approximately $634,000. The gap, $128,000 in James's favor. He didn't answer a single call to earn it. Here's what the number comparison doesn't show. Claire's $506,000 is locked inside a single asset in a single neighborhood. To access any of it, she has to sell. Months of process, 5 to 6% in transaction costs, a capital gains event. She can't sell 20% of the house when she needs liquidity. Her entire wealth position sits on one street, one local economy, one structure built in whatever year it was built. James's $634,000 can be sold in seconds. Any portion, any morning. His wealth is spread across thousands of companies, across dozens of industries, and every major economy on Earth. The gap isn't just $128,000. It's $128,000 plus 20 years of Saturdays that no account balance can refund. Claire worked for it. James waited. That's the whole story. For most people who think they want to invest in real estate, the question was never whether real estate can build wealth. It clearly can. The question is whether they actually want to own a business that happens to be a house, because that's what a rental property is. It has customers, which are your tenants. It has a product, which is shelter. It has operational costs and a management requirement that doesn't pause on weekends or national holidays or the week you were supposed to be on holiday. If you want to run that business well, the numbers can work, especially with strong local appreciation, quality tenants, and real management ability. If you want to build wealth without running a business on the side, the index fund is the cleaner vehicle. Invisible, requiring almost nothing, and worth more at the end of 20 years than the thing you could drive past. I didn't expect the gap to be this wide. When I first ran these numbers, I thought it would be closer, maybe $30,000 or $40,000. $128,000 was not what I expected to find at the end of 20 years of two people doing everything right. There's something about a physical asset that makes the stock market feel like a gamble by comparison. Like one investment is real and the other is just numbers changing on a screen. But the numbers don't care what feels real. They just compound. Claire and James both made a reasonable decision with the same $60,000. Neither was wrong about what was possible. Claire was wrong about what kind of investment she was actually making. She thought she was buying an asset. She was buying a second job that comes with an asset attached. If you know someone in the middle of this decision right now, looking at properties, running the rent minus mortgage calculation, feeling exactly like Claire felt in month 1, send this to them. Not after they sign, before. And drop a comment below. Are you team real estate, team index funds, or somewhere in between? I read everyone. If you want the real math on your next money decision before you make it, subscribe. It's the edge most people don't have.